Shares for Beginners.
So an investor is somebody who really understands a business, buys into the business to participate in the growth in earnings and the growth in dividends and free cash flow over the very long term, and they're really not concerned about the asset value and the fluctuations. I mean, anybody who is worried about what the Fed might have to say, who's worried about what a company might have to say at quarterly earnings, who checks their share price weekly or monthly, I would actually classify them as traders. But they're probably lousy traders because they don't view themselves as traders, so they haven't learnt the proper risk management framework.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. Is your life vague, fuzzy and unplanned? I know mine is. Are you a victim of circumstance? All the time. My guest today believes that by taking control, you can design your life to achieve your goals. Hello, Simon.
Hi Phil, how are you?
Good. Thank you very much for coming on.
My pleasure.
Now, Simon Ree is the author of the #1 Amazon best-selling book, The Tao of Trading, and the founder of taofoftrading.com. He has 3 decades of experience in financial markets, having previously held senior positions at Goldman Sachs and Citi. His mission is to revolutionise the way finance is taught by shattering long-held myths that have been perpetuated by Wall Street. But before we get into that, I've been, as part of my research, I've been following you on Twitter, and I noticed you seem to be quite acerbic about talking about inflation and people who seem to have an optimistic view of inflation. So you believe that we've got a long way to go in getting it under control?
Yeah, I think so. And look, part of it is we're victims of circumstance. Okay, we had a situation where the Federal Reserve and frankly all central banks ran monetary policy that was far too loose for far too long. And then following the COVID crisis, the pandemic, we had fiscal stimulus being dumped on top of it, with monetary stimulus still way too easy. And then you combine that with supply chain disruptions from the pandemic and then war. And so it's partially a victim of poor policy, partially just a victim of circumstances. But yeah, I don't think these pressures are going to go away. And I think that it's partly due to circumstances, but also partly due to design. When you look at global debt to GDP levels today, they're unsustainable. The financial system is very, very fragile. And quite frankly, if we spent the next decade with an average inflation rate of, say, 5 or 6%, it's probably not the worst outcome, to be honest with you. It's a way for that debt to be made a little bit more manageable without things like hard defaults, which can be very painful. They can result in societal unrest, conflict, and certainly long drawn-out kind of legal proceedings.
And historically, 5 or 6% size interest rates aren't really that uncommon.
No, they're not. They're not at all when you look back over any period beyond the early 90s. And what happened is we've had what was known at the time as the Great Moderation, where we had strong economic growth with really no inflation. In fact, central bankers used to complain that they couldn't hit their 2% inflation target. And that was really a result of, largely a result of globalization. Corporates in the developed world started outsourcing all of their manufacturing, or predominantly to China, and that gave deflationary forces a massive tailwind. And it looks like that game is now up for a couple of reasons. Firstly, the pandemic revealed to CEOs around the world just how fragile their businesses have become. They've become very efficient, but with that efficiency came fragility in terms of not having real control and sovereignty over your supply chain. And just-in-time inventory management and these types of issues were revealing in terms of how fragile businesses had become. The other issue, though, is within China itself. I mean, China's population is aging. It's got a pretty awful demographic picture. And China, over the next little while, call it 2 years, 5 years, 10 years, I don't know the precise time frame, but China is going to be less interested in growth for growth's sake and providing maximum jobs. Is going to become more interested in stability and keeping inflation low and having a strong currency, which is a real reversal of what they were pursuing in the 90s and early 2000s.
So what are you seeing as the outlook for markets over the next couple of years then?
Well, I think over the next, let's call it the next decade, or the next 5 to 10 years, I think we're going to see a lot of economic volatility. we may be getting close to the point now where inflation is peaking. Yeah, you're right. I've been perhaps a little bit acerbic about remarks people have made that inflation is due to peak, just looking at things like base effects and, oh, bro, inflation must be down. Look at the oil price. It's a lot more complex than that. But we are probably getting to a point now where inflation is nearing a peak. But that doesn't mean it's heading back to 2%. And I don't think we're going to head back to 2% over the next decade unless something major breaks and unless we have a major debt default cycle. Absent that, I think inflation, it's probably likely to remain in that sort of 4 to 8% range. Now, greater economic volatility is likely to lead to greater financial market volatility because there will be hiking cycles and easing cycles as that inflation oscillates. But it's probably not going to be fantastic for real economic growth either, because when you're in a situation where central banks have pulled guidance, you don't know where interest rates are going to be, you don't know what your costs are going to be because you don't know what inflation is going to be like. It's much harder for companies to make capital expenditure plans and expansion plans, and people just tend to kind of hunker down under that sort of uncertainty. So I would say a decade of high volatility, below trend growth. I don't think markets are necessarily going to collapse, but you might come out of the next 10 years thinking, gee, what was all that about? The stock market hasn't really done anything. Although it's felt both thrilling and terrifying at various points along the way.
I think a lot of beginners don't actually understand the relationship between stock prices and interest rates, because every time there's even the slightest change or a hint of a change, valuations by expert investors and financial analysts necessarily have to change as well, don't they?
Well, that's right. I mean, rising interest rates has a couple of important impacts. Firstly, it increases your cost of capital. A large part of the reason why so many unprofitable tech stocks have had massive increases in stock prices sort of throughout the, I call it 2020, 2021, was because they were able to get access to very cheap funding. And that game is up. The free money era is over. And I don't think it's coming back in the foreseeable future. So that hurts cost of funding. The other thing is, of course, when you're trying to value a company, a typical way of doing that is through discounted cash flow, where you forecast cash flows out into the future, and then you apply a discount rate to those cash flows. And the higher the interest rates are, the higher the discount rate applied to them, which means the lower the valuation.
So you've practiced martial arts. How has martial arts affected the way you think about investing and markets?
I think it's probably less of a thought process thing and more of an emotional response thing. Martial arts, I think they teach you to be humble, because it doesn't matter how good you are. There's always someone better than you. There's always someone who can kick your ass. And it's the same in the stock market. As soon as you start thinking you've got it sussed, it's going to kick you in the butt. I think it also helps you respond less emotionally. A falling stock price can be quite terrifying to people who aren't used to it or haven't experienced it, and they can become very stressed out by it. And stress literally makes us stupid. When we're under stress, our ability to make high quality decisions is compromised. Rolling on the mats with somebody who is trying to choke you out or put you in an armbar is, I can tell you, significantly more stressful than a 3% drop in the S&P. So I think it just helps you respond to the emotional ebbs and flows that the market can throw at you in a less emotional manner.
And there's a creative aspect to it as well, where you've got to be creative in the way that you respond to an opponent. And I'd assume that's the same for markets, because markets are changing so much all the time. You've got to be creative in the way that you respond as well.
Well, I think that's a really good point, actually. I hadn't thought about that yet, but I think martial arts does kind of train you into having a more flexible mindset, because you're right. You never know what your opponent's going to throw at you in a similar way to you. You never really know what the market's going to throw at you. You might think you do in both instances, but there's always room to be surprised. I've been doing this for 30 years, and I'm surprised regularly.
Well, I won't take any claim for that, what I was just talking about with creativity.
Oh,
I heard it on Joe Rogan the other day when he was talking about mixed martial arts.
Oh, very good.
So many of the guests I have on this podcast believe in value investing and that the only surefire way to wealth is long-term compounding passive investing. So is trading something that anyone can do and not lose the shirt off their back?
Yeah, trading is something that anyone can do, and I've seen this firsthand through members that I've had go through my programs. I mean, my oldest member was an 80-year-old lady in Queensland, and when she started with me, she didn't even know how to open a second browser tab on her web browser. And within 3 months, she was making profitable trades and just booking incremental gains as I teach. A lot of books have been written, in the last 2 or 3 decades on why you should just buy the market, just buy now, just keep accumulating, dollar cost averaging, and that works great in an environment where interest rates are low, economic volatility is low, and markets stonks only go up. I think what people lose sight of is how things looked kind of before the 90s, because I think a lot of the people who are active in markets now, who were active in markets before that have probably retired or their voice is less prominent. But history is a powerful teacher, and lost decades are far more common than the just by now advocates would have you believe. So there is a time to just keep adding. But I think that there is also a time where instead of being exposed to risk all of the time, you want to be able to identify high probability moments in time to expose yourself to risk. And really, that's the environment we're in at the moment.
What do you mean by lost decade?
Well, if you look at 2000 to 2013, S&P went absolutely nowhere. It had a couple of big rises, a couple of big falls, but over that 13-year period, it went literally nowhere. And if you've been hanging on for the long term and being a diligent investor, it hasn't paid you anything. And if you look at 1969 to 1979, that was another lost decade. And if you look at real returns on the stock market, we've had 20, 25-year periods where real returns have been virtually zero as well. So this kind of idea of just shut your eyes and buy and hold on and don't worry about the volatility. Look, it can work in certain market environments, but it breeds, I think, a terrible risk discipline and approach to risk management. And I think people's approach to risk management is what's going to separate the winners from the losers now more so than any other time in the last 30 years. And
you don't have a long-term portfolio yourself, do you?
No, I don't. I used to, but I don't see the point now. You alluded earlier about compounding, and it was Albert Einstein who claimed that compound interest was the eighth wonder of the world. And okay, look, I think with interest rates getting back up to something that you can actually touch and feel, that could come back again. But ultimately, the more often, the more frequently you can compound, the more magical it is. If you take $10,000 and you compound it at 10% per annum, at the end of 5 years, you'll have about $17,000. I mean, it's not bad, but it's certainly not life-changing. If you take that same $10,000 and you compound it at 5% per month, you're going to end up with about $335,000 at the end of 5 years. So you start talking about life-changing returns. And 5% per month, it might sound unrealistic. It might sound like magical thinking. But when you're trading options in a very risk-controlled manner, it's actually quite doable, quite achievable for anyone. I've got members who are doing significantly better than that.
So tell us a little bit about the methodology behind the Tao of Trading.
So the Tao of Trading, I mean, Tao just means the way. And the reason I wrote the book is because, why does the world need another book on options trading? There are already hundreds of them out there. And I know because I've read quite a few of them. But all of the ones I'd read were both boring. They're the sorts of book you'd only read if your boss was making you do it. You know what I mean? And that's the situation I was in. And they're quite difficult. And I think sometimes the authors, like to show off a little bit how good they are at complex math and difficult concepts. So I thought, well, what the world needs isn't just another options trading book, but it needs a book on options trading that is both simple and engaging, fun to read. And the number of people who've emailed me or DM'd me and said, I read your book in a weekend, I can't believe it, is really heartening. So I think I've kind of hit that goal in writing a book that's simple and engaging. And in the book, it's not just setup after setup, when to buy. People make the mistake of coming into trading thinking if they just know when to enter a trade, that's it. That's all they need to know. And honestly, it's one of the least important things. The most important thing to becoming a successful trader is risk management, and that is the thing that you cannot skirt on. The second most important thing isn't your entry, it's actually your exit, all right? Because if you don't exit trades profitably, there was no point entering them. Entries are important, don't get me wrong, but it's probably the least important of the three if you're looking at entries, exits, and risk management. And then I also spend a couple of chapters really deep diving into the psychology of trading, because having the correct mindset really is what's going to separate the winners from the losers, or, aspiring traders from professional traders.
And how many people have become professional traders based on your teaching?
So we've got over 1,000 members around the world, and I mean I only hear from obviously a percentage of them, but I'm aware of a handful, maybe half a dozen, who've literally quit their day job to do this full time. But I think that's not the ambition of most people who want to learn trading. That the ambition is to not necessarily quit their day job or quit their business, but to just provide an additional revenue stream, or provide a way of growing their capital more quickly. I guess my two biggest customers, if you like, or demand for our memberships would be people who are staring retirement in the face. Maybe they're 5 years away from it, 2 years away from it, maybe they're even 10 years away from it, but they're asking themselves the question, how am I going to fund my retirement and not make my lifestyle take a big hit? And the other one is, I guess, more sort of millennials who've been priced out of the property market. They can't buy their first home. They've been kind of burnt in the stock market. They've been burnt in crypto, and they're just really wondering how to get ahead financially. And I think trading is a really good tool for both of those groups. And we've got people, we've got engineers, we've got financial professionals, we've got school teachers, we've got yoga teachers. It really is people from all over the world and all walks of life.
Is there an aspect of technical analysis to your methods?
Yeah, look, my trading is purely technical, really.
Mm-hmm. So that's looking at those coloured charts,
Looking at charts, looking at price action. Technical analysis can, at the very least, it can save you from nasty accidents. If you're aware that a stock is breaking below the 200-day moving average, that's often a really big warning sign. And if professional traders like Paul Tudor Jones are aware of and studying things like the 200-day moving average, all of us should be. Anybody who's ever looked at a chart and used that to determine a stop loss point is using technical analysis. The technical analysis we use is a little more sophisticated than that, but we just use common indicators that are available in any charting platform. We just combine them in what is a slightly uncommon way.
Mm. So this podcast is for beginners. Can you just give us a quick overview about what options actually are?
Yeah, sure. So there are only two kinds of options. There are call options and there are put options. You buy a call option on a stock when you think the stock price is going to go up. Just remember, call up, as in call up a friend. You buy a put option when you think the stock price is going to go down. Put down, like put down your bags. And buying a call option, it's a little bit like renting a stock, because you get most of the benefits of ownership of the stock. You don't get dividends, but you get most of the other benefits of owning a stock, albeit just for a finite period of time. So instead of paying $10,000 or $9,000 on 100 Google shares, you might spend $300 or $400 on a Google option. But the money that you make on that option, if the stock rallies 10%, could end up being similar to what you might have made on the stock. But on the downside, if the stock falls 10%, if you spend $9,000 on Google stock and it falls 10%, you're down $900. If you've only spent $400 on the option, you're only down $400. So there's kind of inbuilt risk protection in trading options. But I teach people to be far more proactive on their risk management than that. You want to cut your position long before that happens, and really at the first signs of trouble. The disadvantage with options is that they are a wasting asset. All right, they have got a finite life. You can buy Google stock and hold it, for the next 10 years, hopefully. We don't think Google's going to go out of business. Whereas a Google option that expires on the 16th of December, It ceases to exist on that date. All right. So the time value of money is always working against you. And that's why we use technical analysis to pinpoint and identify high probability moments in time to get exposure to risk. Like I said, rather than just sitting on an ETF or a portfolio and being exposed to risk all of the time, riding the ups and the downs and basically crossing your fingers and hoping that markets will always recover.
And what size stake do you need to get started in doing this kind of trading?
Look, I recommend people start with $5,000 because it's enough for you to put a few positions on, get a little bit of diversity, weather some volatility, some ups and downs. You're going to have losing trades. Losing trades are just a cost of doing business. I have had members start with much less than that, but I generally don't recommend it. I think $5,000 is a good sort of starting balance.
And you don't sell options? Because I know that you can sell options as well, but it's basically only buying calls and buying puts. That's it.
I do sell options, but only as part of a spread, which is a slightly more complex transaction because it involves two legs. You're buying a call and simultaneously selling a call option, or buying a put and selling a put. So it's a little bit more complex, but not much. And yeah, we do cover that in our training.
And that provides a level of protection, I'd presume?
It does. It greatly mitigates the risk of what we call premium decay, which is this wasting nature of options. And in fact, you can even do a trade that's called a credit spread, where that premium decay works in your favor. So you sell something today for $1.50, and then hopefully in 2 weeks later it's worth nothing, and you get to profit the money that you sold up front.
You talk about the myths of Wall Street. What are the 5 big myths of Wall Street?
Yeah. I mean, there are many, but there are 5 that I cover in my book. I mean, my favorite one is this notion that 10% per annum is a fantastic return. And this is a myth that I think has been created and propagated because 10% per annum is approximately the long-term annual return of the S&P 500. And through a market cycle, it's a return that a financial advisor should be able to get you on average without really doing a whole heap of work. But if they can convince you that that's an amazing return, you'll be quite happy to pay them a whole heap of fees for doing that for you. But the fact is, it's actually not that great of a return. Investors with the right knowledge and the right skill set can do much, much better than that. Look, 10% per annum is great if you're already very wealthy. If you've already got $1 million of risk capital, yeah, you can earn $100,000 a year doing that. It's wonderful. But if you've got $5,000 or $10,000, it really is the slow lane to wealth creation.
And then the other big myths of Wall Street?
Well, another one is this notion that finance is difficult and investing is hard and complex. And I mean, Wall Street has made it deliberately difficult. Okay, they've created their own jargon and their own way of talking and communicating, and it's done deliberately to make you feel like an outsider. None of this is particularly difficult. Wall Street certainly isn't launching any satellites anytime soon, and this is all knowledge that is within the grasp of anybody who's got basic PC literacy. The other big myth is this notion that investing is sensible and trading is like gambling, and that there's this notion that if you've got a short time horizon, you're a trader and you know better than a degenerate gambler. I've got a slightly different definition of a trader. I think anybody who buys a financial asset with the expectation they'll be able to trade out of that asset in the future at a higher price is a trader. So trading, it's not a function of time frame, it's a function of purpose. So an investor is somebody who really understands a business, buys into the business to participate in the growth in earnings and the growth in dividends and free cash flow over the very long term. And they're really not concerned about the asset value and the fluctuations. I mean, anybody who is worried about what the Fed might have to say, who's worried about what a company might have to say at quarterly earnings, who checks their share price weekly or monthly, I would actually classify them as traders. But they're probably lousy traders because they don't view themselves as traders, so they haven't learnt the proper risk management framework. One of my favorite myths is this notion that high risk equals high returns. And I think finance as a discipline has conflated the word risk with the word volatility. And they they actually mean two very different things. Volatility just refers to variability in price. To me, risk, it refers to loss of capital. All right. So what Wall Street wants you to believe is that to increase your chances of winning, you've got to increase your chances of losing. And honestly, I ask you, how does this make any sense at all? So what I urge people to do is if they want to increase their chances of winning, they've got to reduce their chances of losing as much as possible. And that all comes with strong risk management. And then there's this notion that buy and hold is the only sensible investment strategy. You can't time the market. You can't beat the market. All of these types of associated myths. Saying that you can't time the market, it's a little bit like saying you can't fly an aeroplane. I mean, yeah, absolutely you can't if you haven't acquired the skill set. But if you acquire the skill set with practice, what once seemed impossible almost starts to feel like second nature. And saying that you can't time the market really just says that either you've never tried or you've tried and failed and you're just parroting conventional dogma.
So are there any other takeaways from your book that you'd like to share with listeners?
Look, in terms of the book, so the book goes into obviously the 5 myths and why I think now is a really good time for people to take control of their own finances. And then in the last chapter, I talk about how to make it happen and how to compound your gains regularly while managing your risk. And I think the point that I just want to hammer home more than any other point is this concept of risk management. Because if you start life as a trader, even if you're not making money through your first weeks and even your first months, so long as you're not losing money, if you stick to the process and you get really good at the process, you almost can't help but be successful eventually. It's people who throw their risk management practices out of the window and blow up their accounts. They're the ones you hear about, and it's nearly always a failure in the trader rather than a failure in the system.
And how much time do people need to devote to trading?
I would say when you're learning the ropes, you probably want to be able to devote 10 to 15 hours a week, all right? And that might take you 4 to 8 weeks to learn the methods, learn how to place orders, learn how to read charts, learn how to run your scans, learn how to operate your broker's platform. Once you've kind of grooved things, and I reckon it usually takes your first 100 trades. Your first 100 trades, really, that's like your apprenticeship. Once you've got through that, you should be able to do this on average in about 20 minutes a day. So all of the trading, well, not all, but 95% of the trading I do is based off of daily charts. So I do all of my analysis when the markets are closed. I run scans, which I share with my members, which enable them to highlight high probability candidates very, very quickly. You still need to do your research, go through a weeding out process on those scan results. But instead of analyzing hundreds of charts every day, you might only need to analyze half a dozen. Sometimes my trading will take 5 minutes. Sometimes it'll take an hour. But I would say on average, it's about 20 minutes to half an hour a day.
So how can listeners find out more? Where do people find out more about the Tao of Trading?
Well, you can follow me on Twitter at Simon_Ree, or you can follow me on LinkedIn at Simon Ree. My website is www.taofoftrading.com. And what I'd like to do, Phil, is offer your listeners some special resources and some discounts on our memberships. If they go to www.taofoftrading, that's TAOOFTRADING.com/SFB, they can access some resources there. They can download the first chapter of my book for free and claim a discount on some of our educational programs.
Fantastic. Well, we'll put all those links in the show notes and the blog post as well. Simon Ree, thank you very much for joining me today.
It's been my pleasure, Phil. Thank you.
If you found this podcast helpful, please tell a friend, especially if it's someone who needs to start thinking about investing for their future. You'll be helping them and helping me to keep this show on the road.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
And thank you for listening to my podcast.